In Punta Gorda Isles, Florida, a couple in their late 50s finished paying off their canal front home 18 months ago. 3 bedrooms, appraised around $540,000, 30 years of payments finally done. Then a letter arrived from a lender they had never spoken to, referencing a home equity line they never opened. Most of us assume a paid-off home is the safest financial position you can be in. Nobody's watching it anymore, and that's actually the problem. The one thing standing between your house and a stranger's forged signature just disappeared, and almost nobody realizes it happened. So here's the question worth sitting with. If no bank is watching your title anymore, who is? That gap is what this video is about. And if you don't understand it, the fix stays invisible until a letter like that one shows up in your own mailbox. My name is Alex, and if you've ever felt like paying off your house should have made you safer, not more exposed, stick around, because that feeling is backwards. I'm going to show you exactly how someone can steal a paid-off home with a single forged document, and the 5 free steps that shut it down before it starts. Once you understand how this crime actually works, you'll stop treating your deed like paperwork and start treating it like an asset that needs a lock. The reason that gap exists traces back to one detail. Nobody explains when you make that final payment. For years, someone else was quietly doing a job you never asked for and never even noticed. Why lenders are your only watcher. Here's something you've probably never thought about. Every month you sent in a mortgage payment, a small army of people at your bank was quietly protecting a house that legally belonged to you. That sounds backwards, but it's true. And once you understand why, the risk of paying off your home stops feeling like a mystery and starts feeling like basic math. Think about Gregory Hansen, a dental hygienist outside Reno, Nevada. When Gregory bought his house, the bank ran a title search. When his tax bill came due, the bank made sure it got paid through escrow. When anything unusual touched that property's paperwork, someone at the bank noticed because the bank had roughly $300,000 of its own money riding on the fact that Gregory, and only Gregory, owned that house free of any competing claims. That's not customer service. That's self-interest. The bank was never protecting Gregory. It was protecting its collateral, the same way a lender financing a $200,000 Range Rover autobiography keeps tabs on the vehicle's title until the loan is paid off. You just happened to benefit from it the whole time, without ever being told that's what was happening. Now here's the part that changes everything. The day Gregory made his final mortgage payment, all of that oversight ended. Not gradually, immediately. The bank got its money, closed the file, and walked away. Nobody at that bank has any reason to think about Gregory's house ever again. And that's the actual mechanism behind this whole problem. It's not that paid-off homeowners are careless. It's that the one institution with money on the line, and therefore a reason to watch, has no money on the line anymore. So who's watching now? Nobody. Not the bank, not the county, not an app on your phone. The county recorder's office processes documents. It doesn't investigate them. Your name sits on a deed in a filing system that anyone can access, and no one is cross-checking new filings against your identity unless you ask them to. This is where the math actually gets uncomfortable. The average mortgaged homeowner in America is currently sitting on around $310,000 in home equity. If you paid your house off completely, your number is probably higher, sometimes far higher. That's real spendable value sitting behind a single piece of paper at the courthouse. And for the first time since you bought the place, nobody but you has any financial stake in protecting it. It's a strange trade. You spend 20 or 30 years paying down a loan specifically to get free of the bank, and the moment you succeed, you also lose the only entity that was ever checking your title for you. Nobody hands you a warning label with your final mortgage statement. It just quietly happens. And scammers know exactly which homes fit this description. Paid off, no lender watching, no red flags, just an owner who reasonably assumes the hard part is over. So the real question isn't whether paying off your mortgage was a good decision. It obviously was. The question is what happens in the gap it leaves behind, and how someone with the right piece of paper and a little bit of your personal information can walk that gap all the way to your front door. How criminals actually steal a deed. Here's a question worth asking. If someone wanted to steal your house, would they even need to break in? They wouldn't. They'd need a printer, your name, and about 20 minutes at a government office that isn't set up to stop them. That's the whole operation. And once you see the mechanics laid out step by step, It stops sounding like an urban legend and starts sounding like something with a very specific, very learnable process. Let's walk through it using someone like Denise Okafor, a hospital billing coordinator in suburban Ohio, as our stand-in for how this actually plays out. Step 1 is identity theft, and it's usually the least dramatic part. A scammer gets Denise's full name, her date of birth, and her property address. Sometimes it comes from a phishing email. Sometimes it's mail stolen right out of an unlocked box. None of this requires hacking skills. It requires patience and a few pieces of information most of us hand out without thinking twice. Step 2 is where the forgery happens. The scammer drafts a deed transferring Denise's house out of her name and forges her signature on it. And here's the detail that makes this crime so specifically dangerous. They almost always use something called a quitclaim deed. A quitclaim deed is about as simple as legal paperwork gets. It transfers whatever ownership interest exists from one name to another. No guarantees required, no title search required, no verification required. That simplicity is exactly why it exists, for legitimate situations like transferring property between family members. And that same simplicity is exactly why it's a criminal's favorite tool. It's one of the easiest documents to file, which makes it one of the easiest documents to fake. Step 3 is the part that should genuinely bother you. The scammer takes that forged deed to the county recorder's office and files it, and the clerk at the counter isn't checking whether Denise actually signed it. Their job is administrative. They confirm the paperwork is formatted correctly, and they file it. Signature verification against Denise's real signature simply isn't part of the process in most counties. The fraudulent deed becomes part of the official public record, sitting right next to every legitimate document tied to that address. Step 4 is the payoff for the criminal. Now that the county's own records say Denise no longer owns her house, the scammer can take out a large loan against the equity, or list the property and sell it outright to a buyer who has no idea anything is wrong. This isn't a hypothetical. In Detroit, federal prosecutors charged a 60-year-old community organizer named Zena Thomas with stealing more than 30 homes using exactly this playbook. She forged quitclaim deeds, made the properties look like they belonged to fake entities, and sold them to unsuspecting buyers. 30 homes. One method, repeated over and over, because the system let it work every time. And that's really the uncomfortable core of this whole crime. It doesn't require sophistication. It requires a government process built for efficiency, not verification, and a target who has no reason to be checking the county records on any given Tuesday. Denise finds out the same way almost every victim does. Not from an alert, not from a phone call, but from a letter in her mailbox weeks or months later, referencing a loan or a sale she never agreed to. By then, the fraud isn't a theory anymore. It's sitting in the public record with her name attached to a transaction she never made. So the paperwork gets stolen quietly, and it gets recorded quietly. But what a criminal does with your house, once they legally appear to own it on paper, that part isn't quiet at all, where your stolen equity really goes. Here's something worth sitting with for a second. That number sitting in your home, the one you've spent decades building, doesn't disappear when it's stolen. It just shows up somewhere else, in someone else's life. So let's actually follow the money, because this is the part that makes the crime feel real instead of abstract. Take a homeowner like Todd Bracewell, a plant supervisor outside Columbus, Ohio, who paid off his house 4 years ago after 26 years of payments. On paper, Todd is sitting on serious value. The average mortgaged homeowner in America currently holds around $310,000 in home equity. And a home that's been paid off completely, especially one that's appreciated for 2 or 3 decades, often holds quite a bit more than that. Now imagine a scammer files a forged deed on Todd's house, then walks into a lender and takes out a large equity loan against it, using paperwork that says he legally owns the place. That money isn't sitting in a savings account. It's moving fast into things designed to be hard to trace and easy to enjoy. Here's where it gets strange. A stolen equity payout in the low 6 figures doesn't get spent on groceries. It gets spent on a down payment for a Range Rover autobiography long wheelbase, financed the same week the fraudulent loan closes. It buys a Hermes Birkin 30 in Togo leather with gold hardware, purchased in cash from a resale boutique that doesn't ask many questions. It buys a Rolex Daytona, the one collectors call the Panda dial, picked up from a private seller for close to full retail. And in the more organized versions of this crime, the ones where someone forges a deed and sells the entire house outright, rather than just borrowing against it, the numbers get even bigger. Proceeds from a fraudulent sale can fund a down payment on a waterfront listing in Naples, Florida's Port Royal neighborhood, where homes routinely list in the seven-figure range. Some of these operations move fast enough that a scammer will charter a Gulfstream just to close the deal in person before anyone catches on. Sit with that contrast for a second. Todd spent 26 years making payments on time, skipping vacations some years, driving the same car longer than he probably wanted to, all to build equity in a house that was supposed to be his safety net. And a stranger with a forged signature can convert that entire safety net into a luxury watch and a car lease in the space of a single afternoon. That's genuinely the part of this crime that should make you angry, not just alert. It's not just theft. It's a redirection, decades of your discipline, converted into someone else's weekend. And this is exactly why the crime keeps happening. There's real money on the other end of a forged signature, and the payout is fast. A scammer doesn't need to slowly drain your bank account, one small transaction at a time. They need one successful filing at the county recorder's office, and the entire value of your home becomes available to borrow against or sell outright. So the equity was never really gone. It just moved quickly and quietly into somebody else's garage, wrist, and closet. And once you see where that money actually lands, the national numbers behind this crime stop being abstract statistics and start looking like a pattern worth taking seriously. The national cost of deed fraud. Here's a number that should stop you for a second. Last year, Americans reported more than $275 million in real estate fraud losses. Not over a decade, in a single year. And that number is still climbing. This crime lost about $145 million 2 years ago, then about $173 million the year after that. Now it's over $275 million for more than 12,300 reported victims. That's not a small trend. That's a crime getting faster and more common year over year. Here's the part that should really get your attention if you're over 50. Homeowners age 60 and older accounted for roughly $123 million of that total, out of just under 2,500 complaints. That's not a coincidence. Older homeowners are more likely to own their homes outright, which means they're more likely to be the exact target this crime is built for. If that's you, or if it's your parents, this section isn't hypothetical. Let's bring this down to one person, because a national number doesn't really land until you see what it costs one household. Take someone like Renata Vasquez, an accounts manager in suburban Georgia, whose paid-off home gets hit with a forged quitclaim deed. According to the title insurance industry's own claims data, the average cost of a fraud and forgery claim, once you add up legal fees, equity losses, and other damages, comes out to over $143,000. And if the fraud specifically involved someone taking out a loan against the property, that number climbs even higher, averaging around $207,000. Now you're probably thinking, doesn't title insurance cover this? And here's where it gets complicated. Title insurance is built to catch problems from before you bought the house, not fraud that happens years later, after you already own it outright. We'll get into that gap in a minute, but for now, just hold on to this. The insurance most people assume protects them wasn't designed for this specific situation. So if Renata wants her name cleared and her house legally back in her name, she has to file what's called a quiet title lawsuit. If nobody contests it, that typically runs $1,500 to $5,000 in legal fees, plus a few $100s in court filing costs. That's the good outcome. Here's the bad outcome. If the scammer who stole her house, or the buyer who unknowingly purchased it from that scammer, decides to fight the case in court, legal fees can climb past $10,000, and the whole process can drag on for more than a year. Imagine that. More than a year of not being able to sell your home, refinance it, or prove in any practical sense that it's actually yours, all because of a signature you never wrote. So let's add it up honestly. $143,000 in average losses, a lawsuit that costs anywhere from $1,500 to $10,000 just to get your own name back on your own deed. Months, sometimes years, of your life spent untangling a piece of paper you had no part in creating. And here's what makes this genuinely frustrating. Compare that to something like credit card fraud, where the bank usually reverses the charge within days, and you barely notice it happened. Deed fraud doesn't work that way. There's no automatic reversal. No customer service line fixes it for you. You're the one who has to prove, in court, that your own house belongs to you, which raises a fair question. If the losses are this steep and the recovery process is this brutal, why doesn't the insurance most homeowners already carry simply cover it? Why title insurance doesn't cover this? Here's a question almost nobody asks until it's too late. You paid for title insurance at closing. So why doesn't it protect you from exactly the kind of fraud we've been talking about? The honest answer is that it was never built for this. Title insurance exists to catch problems from before you closed on the house. Things like an old lien nobody disclosed, a mistake in the public records, an error nobody knew about. It's protection that looks backward, at the history of the property, up to the day you bought it. Deed fraud happens forward, years after closing, once you already own the place outright. That's a completely different window of time, and the standard policy simply doesn't reach into it. Think about someone like Walter Kimbrell, a retired machinist in South Carolina who paid off his house 11 years ago. Walter has a title insurance policy sitting in a folder somewhere, and he probably assumes it covers him for life, because in a sense, it does, for the specific problems it was designed to catch. But if a scammer forges a deed on Walter's house next year, his original policy likely won't pay out, because the fraud didn't exist on the day he bought the policy. It didn't exist yet. Now, here's where it gets a little more hopeful. The industry actually built a fix for this gap, and it's worth knowing the name. It's called the Alta 49 endorsement, and it adds coverage specifically for forgery that happens after closing, the exact scenario we've spent this whole video walking through. It rolled out a couple of years ago, and it's still expanding state by state. But where it's available, it typically adds somewhere between $50 and $150 to the cost of your policy. That's it. A one-time cost, roughly the price of a nice dinner out, for coverage against a crime that averages $143,000 in losses. Now you're probably thinking, if this fraud is so rare, why bother? And that's actually a fair question, because it is rare. Only around 3 to 5% of title insurance policies ever turn into an actual claim. Most homeowners will never deal with any of this. But here's why that logic doesn't quite hold up. Think about a house fire. House fires are rare too. Genuinely rare, statistically speaking, for any one household in any given year. And yet almost nobody argues against installing a smoke detector. Because when a house fire does happen, the cost of not being prepared is catastrophic. You don't insure against things because they're likely. You insure against things because of what happens if they're not caught in time. Deed fraud follows exactly that pattern. Low odds, brutal consequences. And unlike a fire, there's no dramatic warning, no smoke, no alarm going off in the middle of the night. The only signal most people get is a letter in the mail, weeks or months after the damage is already done. So if you already own your home outright, or you're getting close to it, this is genuinely worth a phone call to your title company. Ask whether the ALTA 49 endorsement is available where you live, and what it would cost to add it now, even years after your original closing. For most people, it's a small, one-time expense against a loss that averages 6 figures and takes months to untangle in court. But paid insurance coverage is really your backup plan, not your first line of defense, because there's a set of protections that cost you nothing at all, take about 5 minutes to set up, and can stop this entire crime before a fraudulent deed ever makes it into the public record in the first place. 5 free ways to protect your deed. Here's the good news after all of that. Every single fix for this problem costs you nothing, not $1, just about 5 minutes of your time. Let's start with the single most effective thing you can do because it genuinely changes the whole equation. Sign up for a property fraud alert through your county recorder's office. You can search propertyfraudalert.com, which covers counties nationwide, or just search your county's name along with the words Property Fraud Alert. Most counties offer this completely free. Once you're registered, if anyone files a deed, mortgage, or lien against your property, you get an email or text the same day it happens. Think about someone like Yolanda Prescott, a retired school teacher in Charlotte, North Carolina, who signs up for this the same afternoon she hears about it. If a scammer ever tries to file a forged deed on her house, she finds out within hours, not months. That single alert turns this crime from something that unfolds quietly in the background into something she catches before it can go anywhere. Second, Get in the habit of actually reading your property tax mail instead of setting it aside. A change in ownership almost always shows up on a tax document before it shows up anywhere else, because tax records get updated the moment a new deed hits the county system. If a bill ever looks unfamiliar or lists a name that isn't yours, that's worth a phone call the same day, not next week. Third, once a month, pull up your property on your county recorder's website and just glance at who's listed as the owner. It takes about 90 seconds. You're simply confirming your name is still the only one attached to the deed. It sounds almost too simple to matter, but simple is exactly why it works. Fraud depends on nobody checking. Fourth, and this one shuts down the identity theft piece entirely, freeze your credit at all 3 bureaus, Equifax, Experian, and TransUnion. It's free, and it takes about 10 minutes total. With your credit frozen, a scammer can't use your stolen information to open a fraudulent loan against your house, even if they already have your name, birth date, and address. And when you actually need credit yourself for a car loan or anything else, you can lift the freeze temporarily in a few clicks. And here's something worth knowing about where the law itself is heading. A handful of states, including Texas, Ohio, and North Carolina, now legally empower county recorders to flag and investigate documents that look suspicious before they're finalized, instead of just filing whatever comes across the counter. A few states go even further and require photo identification before anyone can file a deed at all. That's real, meaningful progress, but it's not everywhere yet, and it's not automatic. Until it is, the responsibility mostly sits with you. So here's the fifth piece, and it might matter more than all the others combined. If you ever get one of those fraud alerts, or something about your mail or your tax bill just feels off, move fast. Don't wait until next week to look into it. Call your county recorder immediately and call a real estate attorney the same day. The earlier a forged deed gets caught, the cheaper and faster it is to undo, sometimes before it ever turns into a real financial loss at all. 5 habits, $0. And together, they're the difference between catching this in an afternoon and spending a year in court trying to prove your own house belongs to you. The house was never the finish line. Here's the realization worth sitting with. Paying off your mortgage didn't make your home safer. It just changed who was responsible for watching it. For 30 years, the bank had a reason to protect that title. The day your loan ended, that job quietly became yours. And nobody ever told you the handoff happened. A few things are worth carrying with you. The safest-looking financial milestones can quietly create new blind spots. Institutions protect their own money, not yours. And once their money is gone, so is their attention. And the cheapest protection against a 6-figure loss is usually the one nobody bothers to set up, because it doesn't feel urgent until it is. So take a look at your own deed this week. Check who's actually watching it. If the answer is nobody, that's 5 minutes well spent. There's a related question worth asking next. If your home can be stolen with a forged signature, what else in your financial life is sitting unmonitored, assumed safe, simply because nothing's gone wrong yet? If this changed how you think about your own paid-off home, share it with someone who has one too. It might be the 5 minutes that saved them a year in court.